Up next on the SRI 360 podcast.
There's a joke in the forestry sector, which is like, how do you make a small fortune? And the joke is you take a big fortune and then you invest in a sawmill. We actually bought this business, which is now called Timberlink, and there's two sawmills. The company that owned them was going into bankruptcy, but these two mills were the primary customers for two forests by one of our funds. To protect the value of the forest, let's buy the mills. And we bought those mills for $40 million, and now they're worth hundreds of millions of dollars.
Today, I'm excited to bring you another best of episode to commemorate the SRI 360 podcast's upcoming second anniversary. I've curated some of the best and some of my favorite and most insightful moments from the interviews we've released over the past 2 years. If you're familiar with the podcast, you know by now that I conclude most episodes by asking my guests 5 rapid-fire questions. Another one that always provokes interesting answers is, you don't have to name names, but can you describe an investment that you had some level of skepticism, either at the time you invested, or maybe it caused you to ultimately pass on, and in the end it turned out way better than you had expected, and you were pleased that you had invested, or if you had passed on it, you wished you hadn't, and what were the lessons learned from that experience? I invite you to tune in to this special compilation episode and listen to some of the most compelling responses to this question. It's a treasure trove of short investment lessons from a select group of world-class investors in sustainable and responsible investing. All of these impressive individuals have played a significant role in transforming responsible investing, and you can find their information and links to their full interviews in the show notes. Please enjoy, and thank you for listening. Describe an investment that you were skeptical of, either at the time you invested, or maybe you ultimately passed on it, and in the end it turned out to be way better than you thought, and you were pleased that you invested in it. Or if you had passed on it, maybe you regretted that you hadn't invested in it. And what did you learn from that experience?
So investing in Cameco, we strongly believe that nuclear is part of the clean energy movement and it's going to grow. Cameco is a good producer. So we hoped nuclear would grow, but we were skeptical. We thought it would take a long time, but it's grown much faster than we expected. On the negative side, we were one of the earliest adopters of ChatGPT, and we thought that NVIDIA would be a key contributor to that technology. But we also thought that higher interest rates would be a detriment to those high multiple companies, and we missed this tremendous ride.
We had passed on an investment years ago in a business that was focused on supply chain measurement, supply chain tracking, supply chain transparency, for large brands, so you take a Heineken that's got 100,000 suppliers worldwide through its supply chain. They're helping, businesses like Heineken to make sense of that, to measure, to report out on it. And we didn't end up investing in the business. Done incredibly well as all of these trends have continued to persist. And the lesson to take away from it is, given all the exponential growth we've seen in this sector, the exponential interest we've seen in ESG, it's easy to say wow, how much further can we continue to grow from here? And you really do have to zoom out and say, impact investing is still 1%, less than 1% of total assets under management. We are still in such the early frontier days of this approach, of this movement, that even things that feel very mature right now, ultimately we've got a long, long road ahead.
This is probably repetitive, but India over the last couple of years, I think much of the strength of India more recently has been a result of the blowback against China. And so again, those fundamentals in India are just very, very strong. It's remarkable. Over the last decade, the country has become banked. The country has gone from 1/3 of the population having access to a bank account to 3/4. And what's shocking within that is not only just the vast growth, but the fact that what was once unequal access to banking across the genders, that gap has completely closed. So across men and women, access to bank accounts is on the order of 3/4. The fundamentals are incredibly strong. The valuations are incredibly high. So it's been a difficult investment for the last couple of years from this multi factor approach. And yet it's a country that's done incredibly well. And so, knowing how to time these investments, I think, is part of the challenge and part of the opportunity.
This role we've played in raising capital for these small business recovery funds that we set up in states across the United States. I questioned what we were doing. To me, it felt like a bridge to nowhere. And what's exciting to see now is the federal government is coming out with money for each individual state to dedicate to small business lending, to use it to leverage private capital. And so what we're creating now is a public bond offering. We're working in partnership actually with Morgan Stanley to do this, to create a public bond where investors can buy the bond. The public money is being leveraged, and the proceeds are going to continue to capitalize these small business funds that we've set up across the nation. So now that they can get ongoing capital and recycle capital, they can be an ongoing, reliable, sustainable source for the next 10 years. In partnership and collaboration, again, extending across different actors. So it's taking Morgan Stanley, it's taking state governments, it's taking federal money. It's a lot of collaboration, but through that we can create products, we can create ways for private capital to reach these investments. And so to me, the exciting part of that is what this transaction has enabled and what it's growing into being.
Okay.
To me, the whole reason why I do this stuff, it's not just a moment in time, it's to create change that's lasting.
Well, one that's it's a little aside to this question, but one that's been a very interesting journey is we've been investors in a company called M-Copa for many, many years, and we've watched them pivot in very interesting ways. And they were a solar home system company. And now what they do is they finance smartphones in sub-Saharan Africa. So it's basically pay-as-you-go asset finance. But the first asset was a solar home system. And this new asset is a smartphone. And they've had various reactions to this shift from impact investors, because at first they were, a climate play, a solar play, and that was exciting. And now a lot of Western investors are like, smartphones, solar's better for those people, not smartphone. And I mean, if you think about what's a more productive asset, a smartphone's a pretty productive asset. Also, they sell a lot of secondhand and refurbished smartphones, which are actually better for the environment than a small solar home system. So this is all to say it's been wonderful seeing the incredible journey this company has gone through as they've pivoted and grown dramatically. But it's all because the management team is still laser focused on serving an underserved customer base with products that they actually need and want and use. And so they've always kept their eye on that, even as they've pivoted over the years. So we've kind of doubled down our investment about a year and a half ago.
Again, I'm not sure I got a great example for you, but I can say that I wish I'd bought some stock in Tesla a couple of years ago. I actually bought a Tesla car, and I partly as a bit of an experiment. I thought, let's see how it will work. And a month after having the car, I was raving about it. It was the best car I've ever owned, and I still love it today. And I went from being a real skeptic to a real believer in Tesla. But if only I'd have put my money where my mouth was, I probably would have paid for a car a couple of times over by now. So that's one that certainly got away.
Yeah, so it's maybe not one I've done, but it's the last investment we've done here at Natural Capital Strategy, which is the brownfield project in Iberia, and I already mentioned it. And I was very skeptical that this would work and that we would be able to produce any impact with that or look good. We're buying an existing agriculture operation, but how can we actually achieve any impact? And what I realized is that because we are doing a lot of greenfield investments that could be convinced that there was actually a lot we could do on the impact, and it fit all of our criteria. And on top of that, we were able to actually put in an asset in our 15-year strategy that is producing now immediately yield, which was highly appreciated by many of the investors, which also shows that sometimes you have to kind of not dismiss that you're saying there's no way we can ever achieve that, but actually do the hard work and do the analysis. Is it possible? And then you can be surprised that things are actually possible that you didn't think they were.
An investment opportunity presented to us. Now, it turned out that the timing was we made a good decision on the investment side for when we turned it down, but we should have been back in. But we were looking at an investment opportunity that was bringing back rice, basically food production, but in this case it was rice specifically to Africa. In this case, it was Ghana. And it was reducing rice costs to the end purchaser to 1/3 of what was imported rice. And it worked. At the end of the day, it worked. And it's like, and the business model was good, and it's there and it's thriving. And we were skeptical of the model and skeptical that they had the right people. And I'm like, it worked. You got to acknowledge that, and then say that's one that was missed that we would have been great to have participated in, and great to be able to tell the story of having participated in it.
This one is a fun investment because it doesn't, although it doesn't have a sustainability tilt to it, but I think people will be able to relate to it. Also in the year 2000, we did a co-investment into a theme park in Florida and thought that was a good diversifying investment. Literally 2000. So this is pre 9/11. So after 2001, 9/11, sadly, the investment drops to, 70 cents on the dollar, barely. Tourism dies. We hold on, because we even try to sell it back to the parent that owned the theme park. No chance. I don't even know the year because I didn't follow this trend, but somewhere along the line, they bought the rights to some book thing I had never heard of because our daughters never got into it. We didn't read it. We were into C.S. Lewis and whatever, and into the Lord of the Rings instead of this strange thing called Harry Potter. Never heard of it. And so they bought the rights to it. They created a Harry Potter land. And suddenly they were knocking on our door and wanted to pay us triple what we had invested to get us out because they wanted to own the theme park, Universal Studios Orlando. So there's a good investment that, it was horrifying. It was terrible. And then you stumble into something that you could never have foreseen. And you make a ton of money. From those lessons, you want to be as smart as you can, and it's great to be smart, but I also realize it's really good to be lucky.
Yeah, I mean, in the sustainability area, I've bought into controversial issues, and then I've gotten chastised for it, and then I'm happy. Like Berg, they bought Prima, an Indonesia firm. I've owned their debt and sustainable bond fund for a long time. They became highly levered. Their operating kind of lost focus. Clearly, the cocoa industry is subject to slave labor, abuse, human rights, but they really made long-term transparent strides. They now track 40% of all their sourcing. They made assurances of raising 500,000 farmers out of poverty, no child labor use. We all know, wink, wink, that it still occurs, but the tracking and transparency and the commitment to track and report and do that tough fight. I couldn't be more happy to own such a company because I'm not going to own the Unilevers. I can't own all the shiny sustainable investments and the drive performance and make a difference. So I'm going to own those issuers that are going to be where I see that have made these strong strides of making a difference. Now, Berg, it's like, not only they've been world-class purveyor of chocolate and doing the right thing, but they actually have a very impressive sustainability model that I think is going to get much more attention and accolades. And I've been a holder of them probably for 3 to 4 years.
There's a joke in the forestry sector, which is like, how do you make a small fortune? And the joke is you take a big fortune and you invest in a sawmill. And anyways, but we actually bought this business, which is now called Timberlink. And there's 2 sawmills. The company that owned them was going into bankruptcy. But these 2 mills were the primary customers for 2 forests owned by one of our funds. Yeah. And so we had never operated a sawmill before, not done any of this, but we took the risk and we said, we were very nervous about it, but we thought defensively, this is the right thing to do because there's one forest. So to protect the value of the forest, let's buy the mills. And we bought those mills for $40 million, and now they're worth hundreds of millions of dollars.
I approach every investment with skepticism, but it's not about the company. I'm actually far too Pollyanna about most companies. The skepticism is about my ability as an investor, which maybe that makes me a better investor. It's because I'm always questioning my ability. But I'm going to give you the most obvious example. For example, when I met my husband, he had just joined the startup that was 12 people called Netscape. I never would have invested in Netscape. And I'm choosing to talk about that one because some people will know the name, but I knew it intimately. I knew the people doing what they were doing. I knew how qualified they were. I knew all the things an investor should have known to invest, and I still didn't invest. And here's why. I wasn't a believer in a vision. And that was so good for me to learn in 1995 because I've been able to apply it to every entrepreneur since. I'm an investor. I'm not an innovator. I may not know where this market's going to go. So this is why I love the SIFT. A crowd, you actually do find people who are believers and who can see that and who can see where markets are going. I can't. So I rely on entrepreneurs to take me to markets. Clean tech, I'll never forget. Basti was very early into clean tech, venture investment in clean tech, because innovators were taking us there. Stem cell, the commercialization of stem cell research. We were very early into that because that's where entrepreneurs were taking us. I individually struggle to see where things are going. I'm not a visionary as it relates to innovation, but I found the tool, the expert SIP, to help me see into the future. But yeah, no, I would have passed on Netscape because I couldn't see what people were going to do with the internet. And I'll never forget the first commercial I saw with the www.toyota.com. And I went running to Tim and I said, Tim, there was a URL on TV on a commercial. He said, yeah, everyone's going to have one soon.
An investment we did at the Nature Conservancy right before I left was something we partnered with Third Way to create a working capital fund, again, for ecotourism operators who were close to shutting down during COVID because of the complete drop-off in tourism. And the idea was, here's something to keep the lights on in exchange for taking this capital, which was relatively low cost to them. Here are some conservation and community covenants that we want you to put in place that will increase the benefit that your operation has on communities and ecosystems. And I've left, so I don't know how well the deal did, but I do know that they were able to raise a substantial amount of money and really put a lot of money to work in regions that desperately needed it at that time. But there was a lot of skepticism that we could move fast enough, that we would really make a difference, that these operators would change their behavior. And I think, we should check with my successor at NatureVest, but I think it has been a big success, and the deal really, to me, that's the kind of creative structuring that really works.
I had some opportunity to work in the early days of our work on end-of-life care. And, that was not instinctively an area. I've given you those sort of features that I think work well with social impact bonds. It wasn't obvious to me that this was going to be, the place for social investment. How are we going to measure these outcomes? It's hugely sensitive and difficult. But actually, it's just proved not only, really a really important area for social investment, but really important in terms of the impact we can have. It's such a critical time of life. And actually, we've been able to use the investment to really build services and transform services in a way that helps people and families and their carers, achieve what they hope for that time of life. So that was a surprise to me.
It's not in investing in companies where I was the user of the product, actual user of the product, and thought, wow, this is really solving a problem or a need, or it's making my life easier. And I just didn't translate my usage pattern to how big those businesses could become. So early days, I wish I invested in Apple when the iPad came out, because it didn't occur to me that everyone in the world was going to use an iPad. And, early days, Starbucks, I had that first cup of Starbucks coffee and I saw it proliferate, and I thought even though I was going to Starbucks every day, getting my coffee every morning, and then all of a sudden seeing it in our canteen and everywhere else, I should have invested way back then when I was using it, saying this is something that I can see myself as a repeat user using or whatever. So I think those are, I'm generalizing now, but it's those where I didn't translate my own usage patterns into why wouldn't I invest in the company if I think it's so fabulous. I think that's probably a very good example.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.